Currently, the media is extensively reporting only on the news of the Iran war, but I suspect that a financial crisis originating from the private lending market, which is more dangerous than the 2008 subprime financial crisis, is underway. The private debt financing that has led the Nasdaq market is cracking, and it is no longer just a hairline crack, redemptions from a few funds, but a situation where the glass is shattering, a financial crisis caused by a fund run. Sensing this crisis, institutions and big investors are staking everything on securing liquidity.
Yesterday, another fund, Apollo, suspended redemptions, and today one more was added, the Heirs Fund. Apollo Global Management, APO, had restricted redemptions of its flagship private debt fund, Apollo Debt Solutions, ADS, on March 23, 2026. The fund received withdrawal requests amounting to 11.2% of its total shares for the first quarter of 2026, and Apollo adhered to its pre-established quarterly limit, capping redemptions at 5% of the fund's outstanding shares. Investors who requested their money back will only receive approximately 45% of the capital they sought to withdraw, around 45 cents on the dollar.
The APO fund manager cited the semi-liquid nature of the product, noting that investments are tied to private businesses and loans that cannot be liquidated instantly without damaging the portfolio's value. This move has sparked concerns over a liquidity illusion in the $2 trillion private credit market, where retail-focused products offer access to illiquid assets. Other major firms, including Heirs Management, also restricted redemptions around the same time, signaling broader sector-wide pressure. Although it is usually advertised that quarterly redemptions are possible, the fact that the actual assets are unlisted loans that are difficult to recover reveals a liquidity illusion at the time of large-scale withdrawals.
Bloomberg pointed out that the persistence of large-scale redemption requests suggests that investors are beginning to worry about a liquidity crunch in the illiquid private debt market. Private debt is a market where asset managers or private equity funds, rather than banks, provide direct loans to companies. It has grown rapidly following the tightening of banking regulations after the global financial crisis. Recently, investors have expressed concerns regarding the lack of transparency in the private debt market, weakened loan screening standards, and exposure to software companies whose business models could be shaken by artificial intelligence, AI. Some are questioning whether private debt, which involves lending directly to companies, is a suitable investment product for investors seeking a certain level of liquidity. At an investment conference held in Phoenix yesterday, Mike Arrighetti, CEO of Ares, stated regarding this, "I hope a rational judgment is made," adding that the 5% quarterly redemption limit is not an arbitrarily determined figure. He explained that the decision was made after taking into full consideration natural liquidity levels and the fund's structure, adding, "This fund is not a product where investors say, 'I don't want to invest anymore, so give me my money back immediately.'" Pressure for capital outflows is intensifying as Moody's recently downgraded the ratings of some private debt funds or issued negative outlooks.
Until now, asset management companies have marketed private credit funds as safe assets that offer higher returns than bank deposits and allow for quarterly redemption. Individuals who received only 45 to 50% of their requested amount back this time realized that the promise that you can withdraw money at any time does not work during a crisis. Going forward, individual investors will scrutinize the risk of inability to withdraw funds early much more strictly when investing in unlisted assets, which is highly likely to significantly slow down the pace of new capital inflows.
If money flowing into funds decreases, the funding sources for small and medium-sized enterprises and startups that they lent money to will dry up, which could lead to a contraction of the real economy as a whole. In fact, as Neocloud companies have recently been unable to secure GPU loans in the private lending market, they are aggressively proceeding with convertible bonds and ATM paid-in capital increases.
The private lending market is shadow banking conducted outside the banking sector, and vulnerabilities in this shadow banking are currently being exposed. It is speculated that news of redemption restrictions on a specific fund is spreading anxiety to other healthy funds, potentially leading to a fund run where investors try to withdraw money even from sound funds. Moreover, since private loans are connected to general banks, this creates a dangerous situation where a fund run could easily escalate into a bank run. Recently, as safe haven assets such as gold and silver have plummeted, institutions and major players are scrambling to secure liquidity, dollars.
Disclaimer: the information above is based on general market data and is not an investment recommendation. Stock investment carries the risk of loss of principal, so please consult with a professional.